Good evening and welcome to World Investor Week 2020. On behalf of the Center for Capital Markets and Risk Management, IIM Bangalore, I, Anvesha Sinha, welcome you all. The Center for Capital Markets and Risk Management at IIM Bangalore and National Stock Exchanges Investor Protection Fund Trust launched the Platform for Investor Education (PI) on 14th August 2020. The platform is easy to navigate, free and product neutral. It aims to enhance financial literacy and enable investors in volatile times. Mr. Nagendra Parekh, Executive Director, SEBI, Mr. Vikram Limai, Managing Director and CEO, National Stock Exchange, and Professor Rishikesha T. Krishnan, Director, IIM Bangalore, launched the platform. Financial education encompasses understanding financial concepts, possessing the ability and confidence to manage personal finance, by taking short-term decisions and long-term planning, considering individual life cycle events as well as changes in economic environment. The Platform for Investor Education is a step in empowering people in this direction as it is product neutral. The platform has a collection of audios, videos, blogs and podcasts to enlighten one and all about the need and utility of investments in today's world. The audio content is available in multiple languages, making it accessible to investors across the country. Professor Jaidev, faculty, IIM Bangalore, is the chairperson of the center and a pioneer in the making of PI. Dr. Aishwarya Krishna heads the center. Mr. Sandeep Das is the web designer and developer. Ms. Sandhya is the creator of digital platform for PI. Mr. Prashant has worked on video asset creation for this platform. And I, Anvesha Sinha, am the project lead for PI. Observing that today's financial environment is complex, volatile, and perilous, Professor Jaidev M., chairperson of the Center for Capital Markets and Risk Management at IIMB, in his opening remarks said, "The increasing number of corporate failures, risk of loss of employment, and limited government pension systems emphasize the need to design an investment portfolio that safeguards one against financial vulnerability. The remedy is to enhance financial literacy and financial education. The World Investor Week is being organized by IIM Bangalore in association with National Stock Exchange and Securities and Exchange Board of India from 23rd November to 29th November 2020. Throughout this week, we've organized a series of webinars to raise awareness about investor education and protection. Our speaker for the evening is Ms. Monika Halan. She's consulting editor with Mint, India's second largest business daily, and a well-known media personality. Ms. Monika is the author of the best-selling book, Let's Talk Money, published by Harper Collins in 2018. She has worked across several media organizations in India and has run many successful TV series around personal financial advice on NDTV, Z and Bloomberg. We welcome you, ma'am. I cordially invite Ms. Monika for her webinar on Encountering Pandemic with Quality Investment Planning. The webinar will be followed by a Q&A session where viewers can ask her relevant questions.
Thank you very much. Good luck for the entire week. And it's great that we celebrate things like investor weeks across the world because, finally, it's the investor money which makes the whole world go round, all the markets, all the bonds, all the stocks. So that's fantastic. The topic really was pandemic and what you do. But I believe that if you're financially fit, then it's like having immunity. COVID will come and go. People who have intrinsically strong bodies don't get affected to that extent. People with comorbidities do. I think financial health is very similar, that if you are financially fit, then you have the wherewithal to actually ride out any circumstance which comes. And the point that we need to remember is that we've moved a lot in the way that we think, the way products we consume, in the way that we think about money itself, but the way that we manage our money, the way we think about savings and investing has still remained very 1970s. We're still very risk averse. We still do not trust financial products because they're invisible. We still have this fixation on gold, real estate, and bundling life insurance with investment. But what we need to do is first we need to understand the big picture of our money, which I call Dhan Chakra. It's the circle of wealth. Second, I want to scare you all a bit to understand what you need for your retirement, especially the young people out there. At age in your 20s, your risk is of living too long. Your generation will live till 100 because of all the advancements made in medicine, biotechnology, neuroscience, all of that. And then I want to leave you all with 6 habits which will make you financially fit and will you can ride out any pandemic, any crisis which comes after that. The very big picture is that there is something called a circle of wealth. In the initial years, we have a money box. It's filling with salary more than anything else. So because we are a factor of production, we are labor, we go to work, we generate income. Part of it is saved, part of it we spend, and essentially the big, everybody knows this, that income minus expenses is savings. The only insight here is this a residual or is this a target? And what are you doing to convert savings into investment? So Indians save very well, 17%, and now that's 24% of GDP is savings. But do we really convert that into investing that well? Savings into investment. Three asset classes that we think of when we go to the market, we are hit by products, a large cap fund or a ULIP or a traditional plan or a REIT or a Bitcoin. But what we should understand is that there is a characteristic of each of these, and we need to first understand that whether it's a debt or a fixed income product or an equity product or a real product or a real investment like gold and real estate. The returns on these investments give us rent, interest, dividend, and profit. When this factor of production, which is labor, either chooses not to go to work or is unable to due to ill health or lack of opportunity because younger people have taken that job away, then the money box will fill with the results of that investing done, rent, interest, dividend, profit. Then fill your investment, your money box, and your consulting salary, your inflation adjusted real time income becomes smaller and smaller. So that in one chart really is what happens to our money. And money is your one true friend. It stays with you even if you break up with your girlfriend, boyfriend, husband, wife, whatever, life, death. Your relationship with money is going to last till the very end. So the faster you have a good story about money and yourself, the better it is for you. I mean, this is not one relationship that you postpone for the future. The big question is retirement, especially for this younger generation, because you will have a lot of life left after you have finished working simply because of the advancements in technology, medicine. A rough rule of thumb is that the spending that you're doing annually at age 60, you will need between 18 to 35 times of that for your retirement corpus. 18 times of your spend at 60 if you plan to eat up all of that corpus. Indians don't do that. We like to leave it for the kids. So if you plan to leave the entire corpus, it's 35 times. We take a middle number, 26. And it's if your corpus, if you're spending 20 lakh at age 60, you need 5.2 crore in your retirement kitty. Let's take another metric. This one I've taken from Fidelity. So the numbers sometimes will differ on, in terms of social security that US has and we do, but roughly broadly at age 40, you should have 3 times of your annual income as just your retirement. By the time you're at 50, it should be 6 times. By the time you're retiring at 60, it should be 8 times. And this is that classic question that, do I live today or do I save for tomorrow? What if tomorrow doesn't come? What happens? And this is, I think, a deeper question than just money. It's really about living today, enjoying today, and yet having enough for tomorrow, when and if it comes. So what I give you is not a formula for overnight rich. When you listen to me or you read my book, you don't become rich in a year, but you do become financially fit. You have far more control over your money. You have the money doesn't have you. You see your spending getting streamlined, and you build fitness so that when an emergency like the pandemic or a job loss or something happens, you have enough resources and you're able to live today as well as plan for tomorrow. These are, in short, 6 money habits which lead to financial fitness. At a glance, it is these 6. And what happens really is when we start talking about money and we start talking about investing, we straight away go to target retirement. We straight away think about things like asset allocation, diversification. A lot of times people get into derivatives or day trading or Bitcoin, cryptocurrencies. My insights, what I have to offer to you all is something very simple. It's very basic. It is that we've not even learned to swim in the shallow end, and we want to do day trading. We want to go jump into cryptocurrency. So can we first separate out our spending from our saving? Can we just do that for 6 months? That's your first thing to do, is to manage your own cash flows. And the way that we do it is I open three bank accounts. One account, I label it income account. All the money which comes in, salary, rent, bonus, whatever comes, flows into one bank account. Every month you remove what you're going to spend to a second bank account, and I call it my spend it account. The only spending I will do will be out of this account. And the third is my invested account. This is your savings. This can be a residual or it can be a target. And that really will define what your financial fit quotient is going to be. So if it is a target, then out of your income, you're going to say, I'm going to put 10% or 20% away first into my invested account before I move the money into my spend it account. Now, when you label these accounts, you're drawing upon a very deep behavioral economics insight, which says that when you label something, you typically, the human mind doesn't like to distort, doesn't like to break those labels. So when you've labeled something invest it account, you will find yourself not drawing down that money for an impulse purchase, for a gadget, for a holiday. That money begins to accumulate. And this is the experience of literally hundreds of people who've read my book and come back and said, you know what, this system really works. I did not know I could save that much money. And remember, we are not even beginning to invest. All that we are doing for the first 6 months is to separate out my spending from my saving money. Because remember, this money is a long-term relationship. You've got a runway of the rest of your life available for this. So even if you spend 6 months figuring out your money rhythm of how much you spend, what is your capacity to save, are there sudden things that you hadn't thought about? So use the first 6 months to figure out your spending and saving propensity. If there's nothing going into the invested account, you are spending too much. If you have credit card debt, if you have debt which is a very large overhang, of course you're in trouble. And that the minute you start seeing no money going into your invested account, you know that you need to worry. You know you need to rein in spending or increase income and start paying off that debt, so that we start building infusions into your invested account. So that's your very first step. Second step, we are not doing investing even now. All we are now doing is building an emergency fund. This is a very powerful tool to have, because uh, people don't like to put money away for the long term, because they think, what if I need it? And this is especially true for people investing in stock markets. When they buy something like real estate, they know they're anchored for the long term. Even when they buy a bundled insurance plan or gold, they know that this is very long term. But financial markets seems to freak people out, and they'd rather have access to that money. And the excuse that a lot of people do give, and it is a real fear, that what if I needed the money midway? What if there was an emergency? So I'm saying build an emergency fund. It should be between 6 months to 2 years of your annual expense, so of your spending. So whatever you're spending in a month times 6 or 2 years, the older you are, the larger your emergency fund should be. So by 50, you already have most of your retirement corpus in place. Keep 2 years worth in a more liquid form than, say, just a very tight equity allocation, because the attributes of the emergency fund are, it should be easy to access. You should be able to get your money within a week at very low exit costs or zero exit cost. And it shouldn't cost you too much to keep the money in that product. So typically bank deposits, fixed deposits are great. But of course, if you understand debt funds and if you understand how to use debt funds, typically you would be putting your money into a short-term debt fund, or investors who understand markets a little bit could even think of a conservative equity. But usually it's good to keep your emergency fund money very, very safe. So a short-term very high credit rated with low credit risk, high liquidity, short-term debt fund are great products to have. If you do not understand debt funds, either talk to a planner, or there's no shame in being in fixed deposits, because this is your emergency money. So this is literally the first financial product you build, which is an emergency fund. Third, you have to build your own spending, saving, and borrowing formula. These are your ratios. There is no one size fit all. I'll give you a broad direction. There's a road which goes somewhere, but you have to decide whether you want to ride a bus on it, or what you want to do, whether you want to be in a cycle, or how you want to navigate on that road is up to you. So take the system that I'm giving you and modify it according to your needs. We have a market which produces products and sells it to anybody. I'm saying turn that around, find out what works for you, and then buy a product to solve that problem. So these are thumb rules, but modify it according to your age, stage, risk appetite, capacity, goals, situation. A thumb rule is that you spend no more than half of your take home income. You save 20% of your take home income, and 30%, no more than 30% of your take home goes into EMIs. Students with student loans are worrying about their payback, especially because the job market is not that great. Do front load your payments, do get rid of the loan quickly, because the time when you took the loan, interest rates were high, they have crashed. You are sitting on very high interest student loans. Either negotiate with another bank to bring that rate down. But if you're sitting on a student loan which is 10 to 12 or even higher percent, please negotiate this down, because interest rates have really dropped in the last 1 year. So these are the big broad ratios that we can talk about. Remember that these, again, you will have to modify according to age and stage. In the 20s, there's very little elbow room to save. Your starting salaries are small. There's debt to be paid off. There is student debt. If you have credit card debt, it's a really bad idea. You should pay that back. You're paying 36 to 46% interest on that. If you've been adventurous enough to borrow on these apps, which give you 5,000 bucks on your mobile, you're in deep trouble, because they have access to your social media footprint. And if you can't pay back, there are ways that they will use your photographs. So don't, and I'm scaring you here, do not take money on these apps for your dinner or that dress or that gadget. It is going to come and bite you very badly at a later stage. Good debts really are when you build an asset out of it. So you've spent on your education, that's fine. You need to pay that back. As and when you build a house, don't be in a rush to do that. That is the loan that you take. You can extend yourself and take half of a vehicle loan, half you put cash down yourself. The lesser loan you have, the lesser debt you have, the more stable you are on your feet when crises like this pandemic happen. In your 30s, these are again very high cost years. Most people have started families, their children, student loans may have gone to zero, but yet, it's an expanding, growing family, and your costs are very high. The saving propensity is low. So if you're doing your PF savings and you're managing to save even 10% of your take home, you're okay. So remember, the 20% rule is a rough rule of thumb, but if you're doing, you're doing your PF, you've got another 10%, and you are promising yourself that as money comes, you will increase your savings, you're fine. 40s is normally the time that you get a big income bump. You've been working for 15 years, it starts to pay off. That is the time your student loan is down, you're gone, your home loan is still there. But in terms of proportion, it should have now fallen well below 20 by this stage. This is the stage that you can start targeting higher savings. 50s is a very interesting time. And if you're aware of it already as you're young, that is the age that your kids have grown up, they are financially self-sufficient. Your home is your own, there's no loan on that. Your student life is long gone. That is the time a lot of people are saving 60 to 70% of their take home. This is your highest earning decade, because you're at the peak of your organized work career. So your that surplus is very large. So a lot of people who understand this life cycle target their retirement for that 10 years. There's a danger in that of getting fired in your 50s, and then that plan goes for a toss. So you have to start earlier, but if you have the skill set, then even in your 50s, if you're in a secure job, you can target much higher levels than the said 20% of savings. Habit 4, sensible insurances. Do not bundle insurance with investment. It really harms you. You need medical insurances, 10 to 25 lakh cover. Uh, Life insurance should not be bundled at all. Only people who have dependents need it. Everyone doesn't need life insurance. It should be at least 10 times of your annual income or 15 to 20 times of your spend. Now, you don't bundle it because simply of the way that this deal is set up. And very quickly, I'll take you through why it's such a bad deal. And a lot of you are younger, you're setting out. The first year commission that the agent takes is 42,000 on a lakh of premium. In the second year, and then it's a level commission after that is 7,500 on a lakh. The incentive is to hit you with the first premium, and then after 5 years or 3 years, move you to another product because the agent has milked his commission there. So you get trapped into the product, and you change my mind. You happen to listen to me. You happen to read my book, and you say this is a bad deal, and you want to change your mind after the first premium, and you stop. You want to withdraw. You get nothing back. The insurance rules allow insurance companies to keep the entire premium of first year. You get zero back. Now you've paid two premiums. Suppose you've continued, and third year you realize, no, this is bad. I want out. You've paid 2 lakh, you only get 60,000 back. And this is all according to insurance rules. You've paid for 3 years, you change your mind. You've paid 3 lakh, you get a lakh back. 2 lakh, this is a capital loss. We are debating sometimes 10 basis points returns on debt funds. Okay, investors get very hot under the collar on 10 bips difference in rates. But here, there's a capital loss simply because you don't want the product. The exit costs are so high. You've paid for 5 years. These products are sold as 5-year products. And most agent will move you out after 5 years into a new policy, which they get a very high front commission. You've paid 5 lakh, you only get 2.5 lakh back. These are terrible. This is where household savings go to die in India, in bundled traditional life insurance products. You don't want your money. And look at why I say they go there to die, because the blue line is your contribution. The red line is what you get back if you stop funding the policy. And why do I say with this conviction that they go there to die? Because the persistency rate, the fifth year persistency, which means a policy sold in year 1, after 5 years, there are only half of those policies left alive. Half have died along the way. So, and we've seen in the first 5 years who's making the money. The agent is making the money, the insurance company, because they book this premium as profits after 2 years. Insurance rules allow that. These are bad deals. You do not get stuck. Habit 5, you have to give your money equity exposure. I'm not talking of day trading. I am not talking of penny stocks. I'm talking of simple equity exposure. These are numbers I've done myself. And this data was ending in March 2020, which is why on the red, you see that big drop. This is 1 lakh invested across 4 different products. So the guy had 4 lakh. He invested in a fixed deposit, in the public provident fund, in gold, and he bought the Sensex. At that time, there weren't any index funds. So we can take a thought example and say that there was an index fund and he bought the Sensex then. Returns on fixed deposit PPF gold are in lakhs. It's between 25 to 42 lakh. The 1 lakh Sensex is 1.7 crore. This is when the market. Now the markets are up 70%. I have not even done the maths here, but you can imagine from that dip in March. Sorry. Let me go back to my screen. Okay, from that dip in March, markets are up 70% since then. So when you don't give your money equity exposure, you're choosing to stay on the bottom of this chart. You're agreeing that safety is so important that you will let go of the growth that the equity markets can give to you. But we're afraid of volatility. We are afraid that markets go up and down, and they do. Look at this graph. If you saw your money in March drop 25%, over a week, it's not an easy thing to see your net worth being shaved. And I think all of us have gone through this period of March. It is deeply, deeply scary. But it takes faith in this, in the movement of this chart, to know that markets go up and down. And how, markets go up and down because in the last 40 years, a 1 day 6% fall has happened 19 times. A 6% 1 day drop in the stock market is stomach churning. But it's gone up 6% 24 times. It has fallen 4% 90 times, but it has gone up 4% 92 times. The worst 1 day ever fall was 13%, but the best rise was 17%. So markets go up and down. So, and the next question that you want to know is, how long is long term? How do you think everyone says invest for the long term? So people who understand maths will understand this is the rolling return data on the Sensex over the last 40 years. For those who don't, there's a simple way to understand it. The first red and blue dot you see to the left of the chart is the maximum 1 year gain that an investor into the Sensex got in any 1 year. So the maximum that he or she got was a 336% return. But there was 1 year in which he lost half his money. Okay. So there was 1 year in which he gained 336%. There was 1 year in which he lost 50%. Now, if you increase the holding period to 2 years, then the maximum gain is 160 and the loss also is reduced. It's reduced to minus 32%. You increase the holding period to 3 years, you're seeing the red dots and the blue dots coming near each other, which means the volatility goes down as your holding period increases. This data was done at the worst of the market in March. So it took about 10 years at that time for there to be no downside in index investing, whether it's the Sensex or Nifty 50. We have Sensex data which goes back a long way, so we use that here. But index investing in Nifty or Sensex is the same for an investor who doesn't want to take a fund manager risk. So this is a 10-year period in which, in this chart, where there was no 10-year period in which you lost money. If I do the math today, I'll get a 7-year period or a 6-year period in which you didn't lose money. All that this chart is telling us is that you have to invest long term in the stock market to get the returns that we saw in the first chart, where the chart is going off. It's a multiplier. How do you invest? Direct stocks are risky unless you can read balance sheets, unless you can predict it's a Biden versus Trump, unless you can predict whether oil prices will go up or down, and you can predict gold prices, inflation. You can read balance sheets, then you invest directly in stocks. If you can't do all of that, day trading is not investing. It is fun. It is speculation. If you're serious about investing, you will start with index funds. They're a very powerful tool for people who don't understand markets to start investing, because what you don't have in an index fund is something called a fund manager risk. The risk that the fund manager takes a call, which goes wrong. We've seen how index investing works in the Nifty or Sensex investing, broad market index. That if, and these are low cost, an index fund on the Nifty or Sensex will cost you between 5 to 25 basis points. You have to look for it. You have to find a tracking error, which has to be low. It has to be a large fund to give you liquidity. It's the lowest cost way of getting equity exposure in your money, because you can buy it and you can fill it and you can forget it, because you will only ride the index. There is nobody taking a call. There is no annual update in terms of exiting this fund because the fund manager has changed or the fund house has changed hands. So you are just riding long-term markets. Mutual funds are great products for retail investors. A whole lot of regulatory action has happened to take that, what we have seen in the other slides in the insurance sector, that big candy of the first high commissions, the way that the rules are geared against the household. SEBI has done an excellent job in constantly moving regulation to stop this conflict of interest between the distributor, manufacturer, and investor. And it's a fairly safe product to onboard, because of the lack of conflict of interest. But you either need a good advisor or you stick with index funds. If you're choosing your own, do the homework, build a portfolio. And that gets me to my next point, that it's not just enough to invest in three funds to say, oh, okay, these are doing well. No, you need a balanced diet. You don't buy last year's winner. So foreign stocks have done very well. Technology stocks have done well. The Indian technology funds investing in the US have seen a 45-50% jump over last year. So you have a rush of money going there, but you're buying last year's winner. Gold was the same. People rushed to buy gold after it had gone up a multiplier. So you constantly then chasing last year's winner and you try and make that one winning punt. So you may make one winning punt in a lifetime investing of 60 years, but you could make 100 mistakes. So it helps to eat a balanced meal. So words like asset allocation, diversification are not just words, you have to practice them. So the Indian thali gives you all the nutritions, the proteins, carbohydrates, minerals, the taste kickers, the sweet, everything is there in the thali. Look at your box, financial product box, as different products are being chosen so that they give you different attributes that a financial plan requires between equity, debt, real estate, even in debt, bonds, government guaranteed products like the PPF, debt mutual funds. Within equity, then there are classifications. And again, there are broad ratios of asset allocation that you work towards. At an entry level, we're just doing a split between debt and equity, okay? And simple rule of thumb is 100 minus age is your equity. It works up to a certain point till say maybe your 80s, but even after that, you need to have it, 20% equity should always be there in the portfolio. So that's your entry level. Once you reach level two in terms of your understanding of markets, your own needs, then you start constructing your portfolio. And I cannot emphasize this enough that finally at some stage in your life, you will need the services of a fee only financial planner because your life gets more complicated as you earn more money, the portfolio grows, your needs from that portfolio will also be diverse. So the stage two allocation will be in equity, you'll need large, mid, and small cap. Again, if you can't choose funds, there's no shame in buying index funds across these three categories of mid cap, small cap, large cap. In debt, you need liquid short-term low duration funds. Debt part of your portfolio also has your EPF, it also has PF, it has the fixed deposits if you have any. All of those are included in your debt allocation. Gold, don't buy jewelry and think you're investing. Nobody sells jewelry. You buy either bonds or ETFs for your gold allocation. Gold allocation typically is 5 to 10%. You shave equally from your debt and equity. Now you've got a mature portfolio allocation. That's your level 3. Now equity is coming down, debt is between 20-30, gold is 5 to 10. Now you introduce your geographical diversification of a 15 to 20%. Again, depending upon age, stage, risk capacity, appetite, you move these ratios up and down, but do remember to calculate honestly all parts of your PF, your any insurance policies that you actually still have, and your fixed deposits, and include them in your debt piece, because we tend to have that PF and then we do asset allocation in my investing 100 rupees into debt and equity. You're overexposing yourself to low return products. So don't do that. Modify these ratios so that it works for you. For instance, a short-term goal will have no equity component at all. You want to save money for a down payment on the home in 2 years. You don't put it in the equity market hoping it will double. Because like we saw, markets go up and down. Nobody can predict what's going to happen in 6 months. All right. Nobody can predict what will happen. If you punt your short-term money in equity, you will lose. Longer term goals need 100% equity allocation. If your retirement is 40 years later, why would you drag it down by putting debt into that? So make your allocation, make your goals, and then split your money according to what you need. So these are the 6 rules. These are the habits to form financial fitness. Once you have these, not only pandemics, you can survive a bad workplace, a bad boss, life events which sort of break you down, it's greatly comforting to have these cushions of money, especially when you go through these periods. And these are, I will just share them with I Am Bangalore, and they can put it out. Some cheat sheets to know how you're doing. You can fill these in to see how you're doing. So it's nice to have this sort of, mapping yourself that, am I doing okay? How many months do I have of emergency money? What are my own ratios? Why do I have them? What is the story about my own money that I tell myself? How much medical insurance do I have? What product do I have? So essentially, your own money diary. And that is all. I'm very, very happy to answer questions. I hope I haven't overshot my time. No, perfect, 6 o'clock.
So, ma'am, we have a question from Samir Savanur. Does monthly spends also include fixed investment like LIC, PPF, etc.?
No, it does not. Uh, Again, like I said, insurance ideally is not an investment, it's only for risk cover. But if you are paying those premiums and you are contributing to PPF, that's part of your invested amount. It's not your spending at all. So, yes, you will be making those contributions, but ideally make it from your third bank account. So, split it even outflow wise. So, it actually helps in your taxation also. Once you start filing your returns, it's then very easy to talk to your CA to say, look, from this account only spending happens, and from this account only investing happens, and these are the places where I invest in. So no, that doesn't go into your spend it account.
Ma'am, Harsh Purohit asks, do you feel that mid caps and small caps will witness a re-rating in view of recent SEBI circular?
Dr. Purohit, small and mid caps usually see a rally after the large caps have finished theirs, but this is a very uncertain market. And I think it's just good to have an allocation according to age and stage. If you already have you already have your large cap or your multi cap fund or flexi cap funds in place, then if there's an allocation, maybe 25% of the portfolio, then I would just keep investing in those asset classes, sub asset classes. And then when the re-rating happens, then you have a delightful year. But there have been years in which the category lost very heavily and people exited these categories. So my only insight is you just have to be there all the time, because the ratings and re-ratings constantly happen, but we can't predict them.
There's another question from Professor Shobhit Agarwal. What does geographic diversification mean?
Okay.
When there are constraints on investing in foreign markets for individuals and anyone in India can invest in stock markets, geographic diversification is a bit confusing.
Right. So, yes, one way is to invest directly into stocks. It's allowed. RBI gives you that limit that individuals can actually buy properties or invest in stocks. For most retail investors, these are bad ideas because we need lawyers, you need infrastructure outside of the country to manage a real estate property. And stock buying directly will prove to be fairly expensive because of the huge costs involved in the brokerages. An easy way is to use mutual funds. Many funds have options, they have fund of funds where they buy either index funds or targeted funds in the markets in the US or in Hong Kong or in Europe, where you can get the local exposure. You're investing in rupees and you're getting your money back in rupees, but they are investing abroad. So the money is you don't have to worry about conversion and reconversion. You are simply buying the fund here in rupees. Do check out some of those sites which are aggregators and like Value Research, Morningstar, Crisil, and see under the foreign funds tab which fund houses have what options. So do take a look. I mean, I find it a very easy way to invest, to get a US technology exposure to my portfolio simply by using an Indian mutual fund. So the transaction costs and the my time and energy which will go in this finding a broker, try and buying direct stocks is not something I do at all. So if I'm going to be buying a mutual fund abroad, I may as well buy something here and then let them invest on my behalf abroad.
Ma'am, ma'am, there's a question from Sanjeev. While entering the equity market, the market phase in which we do so is of utmost importance, right? How could we know whether a drop is a long-term market correction which we could use to enter the market, or whether it's just a temporary speculative fluctuation?
Right.
Also,
Let me
uh,
answer this question. It's very interesting because a lot of people think that it's very important that you time the market and you enter when markets are low. And this is number crunching I've done myself, that the difference between the luckiest investor and the unluckiest investor over a 30-year period was a few basis points. So you understand what I'm saying? That it doesn't matter when you enter the market. If you are following the rules and you're going to be holding this investment long term and you're in the right product. So you're looking at your investing as a one time decision. That is not true. You're going to be earning for your entire life. So it's not that you're liquidating everything and you go to the market and you're hitting it with a large amount. You're not going to do that, which is why the systematic investment plan has been such a game changer for an average salaried household, because it's matching the rhythms of income and investing. So there's a product type, there's a way to invest which matches with your spending and saving rhythm, which is of saving every month. So it unless you have unless you're a speculator, unless you're a corporate treasury, unless you have a large amount that you will get in and get out of the market. This is typically things that speculators do, and speculators have a very important role. I'm not dissing them. I'm not saying that there are people who should not be there in the market. They are extremely important people. And I think you need to figure out, are you a speculator or are you an investor? If you're an investor, then you're looking at investing regularly, every month, every quarter, whatever your income and saving rhythm is. And it doesn't matter when you enter the market. Believe me, it doesn't matter.
ma'am, and this is our last question from Mr. Puneet. For gold component of portfolio, are sovereign gold bonds SGB better choice than gold ETF or gold index fund?
So it depends on your how much liquidity you want. So in terms of attributes, the sovereign bonds are much better because there's no cost. In the ETF and index funds, there is an expense ratio. The sovereign gold bonds actually give you interest. Gold is one financial asset which doesn't throw off rent or dividend or interest. It's only the capital value which changes. But the government is giving you a little bit of a sweetener. They don't want so much money going out to import gold. So they're saying, we will give you a little bit of incentive. So that's great. I mean, it's great to get that little bit of interest. And if you make a capital gain, it's going to be tax free on the sovereign gold bond. The only problem is that if you need money midway, I think the tenure of these bonds is 7 years, then the secondary market is not that robust in terms of liquidating these. You will need to do a little more to sort of liquidate the products. The other thing would be to ladder out this investment if you do want to use these bonds. So you invest in year 1, year 2, year 3, year 4, so that after a 6-year period, you have a gold bond maturing every year. So you get that liquidity in your portfolio. So if you're doing gold investing for liquidity, then you probably need an index fund or an ETF. The other idea, third way to do this would be to split your gold investment so that there is a portion invested in the ETF index for liquidity and there's a portion invested in the sovereign gold bonds for the interest the certainty and also that tax break that you get on the capital gains.
Thank you, ma'am. Thank you for the wonderful webinar. And thank you everyone for attending it. We hope to see you in the further webinars that are taking place this week. Thank you so much, ma'am.
Thank you, everyone. Good luck.
Thank you, ma'am.